Hello, everyone. Welcome back to Financial News in Palos Heights. And of course, we have Ameriprise Financial, and Paul Munichel is representing them. I'm Ron Jankowski with Channel 4. And Paul, you're going to give us a little recap of what's happened.
Absolutely. So we're going to start today's show off talking about projections for the third quarter earnings and our outlook for that. So third quarter earnings estimate release, it gets off to a slow start this week. We just have 3 S&P 500 companies on the docket to report. Once again, though, it is expected to be a somewhat unusual and challenging earnings season. Earnings per share for the S&P 500 companies are expected to be down really about 4 or 5% versus last year on sales growth only of about 3%. The earnings per share forecast is a percentage point or so worse than what was expected ahead of Q1 or Q2 earnings, both of which ended up with results proving to be generally flat versus year-ago levels. Sales growth, however, continues to be very slow slide amid slowing economic growth in most U.S. major markets and around the world. The slow appreciation of the U.S. dollar also remains a point of pressure. Through Friday, the trade-weighted dollar is about 2% year-to-year above estimates and 3% higher versus its year-ago levels. Now recall, we talked about this before, that a stronger dollar is negative for corporate earnings, as foreign-generated profits translate into fewer dollars when converted to such financial means for our purposes. The earnings pressure is also expected to be broad-based, keep that in mind, and we do note that the difference between sales earnings and growth earnings. In normal periods of expansion, the opposite is the norm due to operating leverage. In Q3, however, no sector is expected to see earnings per share exceed sales growth, although real estate might come close, which in our view reflects the rising costs, particularly labor costs and the influence of the stronger dollar again. Companies often pack in short-term expenses to periods in which earnings are already expected to be under pressure, as stock prices tend not to react negatively when results are already expected to be challenged.
And Ameriprise Financial had also supplied us with the morning research notes that include the following. The S&P 500 index futures are modestly lower with U.S.-China trade back in focus as talks set to resume this week. That's going to have some impact on a lot of things.
Yeah, and it's unfortunate because no matter any time the market's down, you can say, well, look at what's going on with China. That may not necessarily be the reason, but you can always point it out as potentially being a reason. So we'll keep an eye on it like we've been doing really all year.
And the yield on the 10-year Treasury is 1.53%, while the 2-year is 1.41%. Both modestly higher after last week's big drop.
Right, so if yield is up, the price is down. Remember that inversion.
And the markets in Europe are higher. Hong Kong and China is higher when it closed. And the WTI crude oil is trading 1.2% following 8 days of lower prices. Gold is down 6.6%. Well, with the WTI crude trading higher, that's going to have impact on some of our gasoline prices.
It could. I mean, remember.
Maybe. Yeah, there's a lot that's sitting there in reserve. So if that's used, then that's going to hold prices
Well, it's
stable.
just ironic. I mean, a few weeks ago we were reporting on the terrorist attack and how that was supposed to send gas prices shooting higher.
Yes.
Big overreaction. Production resumed quickly. And as you reported, what was it, eight straight days of lower prices.
Yes.
So oil came back, one update today. It's not much to read into there.
And we have these huge reserves, so that if that's used, that kind of stabilizes things. I don't know if that was used or not.
I'm not sure either.
Yeah, I'm not sure because they responded very quickly in getting the operation
Production
going.
up again,
yeah,
right.
Right. And the last thing is the shares of GM indicated modestly lower as UAW negotiations stall. sending the nation strike into its fourth week.
That is having its effect on the markets, but we'll see. Hopefully they can resolve those issues soon.
And just to recap, the S&P 500 is the 19% a plus 19% year to date. The Dow is a plus 16% year to date, and Nasdaq is a plus 21% year to date. And as I've always said at the end of our show, they're actually holding very nicely, and we don't see anything that is earth-shaking there.
We had some down days in the market
Yeah.
last week, but as you can see, your year-to-date number is still staggeringly high.
Okay, anything else you want to add, Paul? I think we're at a close for Paul Munico with myself. We're going to ask you to stay with us. We're going to be right back with Your Money. Paul usually has a topic that's of interest. Stay with us. We'll be right back. And we're back with Your Money. And Paul is going to be talking about the inverted yield curve. We've talked about this in the past. We've seen a discussion of recession not too long ago, and it was the result of an inverted yield. What does that mean to me, Paul?
Yep, and you're right. This is something you and I and our shows have talked about often, and anyone watching the markets or the news, it's a headline that's been on a lot. In fact, one of the last recent pullbacks we had in the market, they blamed it on an inverted yield curve. So what it means to you at home and the investor is you just got to keep an eye on what is going on with the yield curve of bonds, because it potentially could be a warning sign for some negative activity coming in the stock market and our economy.
Okay, now we have to get into something very specific. Exactly, how does this yield curve work?
Good question. So here's the yield curve. So when you see the headlines, we're normally talking about government-issued bonds. And you are paid for taking risk. So any bond issued from the government is going to pay an interest rate. Your shorter-term bonds should pay lower interest than your longer-term bonds, because the longer-term bonds have more risk because you're owning them for a longer period of time. When that yield curve becomes inverted, your longer-term bonds now pay a higher yield than your shorter-term bonds. So that's all it means, is the inverted yield curve.
Where does one actually see that curve, too? Where do you get that information from, Paul?
Okay, so you can plot it, and you can see this looking at the news. You can pull up the data. You can go to the computer and pull up the data on the yield curves. But it's a simple plot. So starting on the left edge of the plot are your short-term U.S. bonds with the yield curve rising over time. And then as you move to the right on that axis, you should have your longer terms. So everything should be sloping up because everything is paying interest at this point. But your longer term bonds at the end in a normal yield curve should be paying a higher interest rate, so their slope should be higher.
Okay, that leads me to, we already basically talked about normal, so to speak, but where are we now?
Good question. So now everything is flattened out. So where we should see things slope up and the longer curves slope out even further, because of the environment we're in now, everything's narrowed out. So meaning your short-term bonds and your long-term bonds, they pay very similar amounts of interest. So we call that a flat yield curve. When your yield curve is flat like that, it doesn't take much for it to invert. And that's why we've talked a few times about the yield curve inverting, because we're in this flat yield curve now, and it doesn't take much to change that.
So if you're watching this, you could actually see a potential recession.
That's exactly. So that's, a lot of people view this as a recession indicator. Okay, so conventional wisdom is that investors who choose to accept low yield curves on those longer term bonds, they do anticipate a recession may be approaching. If a recession occurs, the Fed is likely to cut the short-term interest rates that it can control. And when it does that, often when that occurs, the yields on other type of bonds decline as well. So that's why people want to lock in and buy the long-term bonds before the decline and in anticipation of the recession. But to answer your question, is it a reliable indicator, or how do you know what it's going to predict? This is the key takeaway here. So while in the past, recessions typically come after a yield curve, you can say that about anything. It's not set in stone that when the yield curve inverts, a recession is coming. I can guarantee you, which is a weird word for me to say in my business, but I guarantee a recession will come at some point in the future. I don't know when and I don't know why. But when that recession comes, you can wind back the clock and say the yield curve inverted here and look what happened. So that's a key takeaway. Although yield curve inversion is a recessionary sign, it does not mean for sure a recession's coming.
Well, if you're watching it and it could actually make you think that something is about to happen, but it may not. And then if it does happen, you could, as you mentioned, you could wind back and look at the activity and how it arrived at where it's at and what's going on with, if there is such a thing as a recession.
Yep, and I'd like to highlight something you just said. I think you said it's something you can look back and you can think is coming, but it might not come. When you think something's coming and it doesn't come, that creates uncertainty. And that is exactly what's going on in the market now, is uncertainty on what's going to come.
And the market does not like that.
Market hates exactly. The market hates uncertainty, causes volatility. And all we can say in a time like that, that's the time to review your portfolio. While there is uncertainty, while the market doesn't know which way it wants to go, now, right now, is the time you need to be reviewing your portfolio and make sure you're comfortable with the holdings you have.
Paul, I just want to add to what you've just said. So one should be talking to their financial advisor. And if you do not have a financial advisor, could someone ask you a question? If there's a viewer that has some question about what we talked about or other, could they contact you?
Absolutely. Feel free to give me a call directly at Ameriprise. I'm happy to help with any questions or concerns you might have. My phone number is 708-226-3412.
Okay. Anything else you want to add to this, Paul?
No, I think that sums it up. It's a complicated topic. It's one we have talked about a lot on our show.
Yes.
So I wanted to take this time to expand on it a bit to hopefully help people understand a little bit more what it really means.
Excellent. Well, for Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you a good investment day.